Many people believe the stock market is only for wealthy investors, but that's not true. Anyone can invest, and understanding how investors make money is the first step toward building long-term wealth. While the stock market involves risk, there are several ways investors can earn returns over time. The first and most common way is through capital appreciation. This happens when the price of a stock increases after you buy it. For example, if you purchase a company's stock for $100 per share and later sell it for $150, you earn a $50 profit per share. The greater the company's growth and investor demand, the more its stock price can increase over time. The second way investors earn money is through dividends. Some companies share a portion of their profits with shareholders by making regular cash payments called dividends. For example, if you own 100 shares of a company that pays $2 per share annually, you receive $200 each year, even if you don't sell your shares. Many investors use dividends as a source of passive income. A third way to grow wealth is through compound investing. Instead of spending dividends or profits, many investors reinvest them by buying more shares. Over time, those additional shares can also earn dividends and increase in value. This creates a compounding effect, where investments grow faster because your returns begin generating their own returns. Some investors also earn money through short-term trading. They buy stocks when prices are low and sell them when prices rise over days, weeks, or months. While trading can produce profits, it also carries higher risk because stock prices can change quickly, and predicting short-term market movements is difficult. Successful investors understand that the stock market does not move in a straight line. Prices rise and fall every day due to company earnings, economic conditions, interest rates, inflation, global events, and investor sentiment. Instead of reacting emotionally to short-term fluctuations, experienced investors often focus on owning strong companies for many years. One of the most important principles of investing is diversification. Rather than investing all their money in a single company, investors spread their investments across different industries and assets. Diversification helps reduce risk because poor performance in one investment may be balanced by stronger performance in others. In simple terms, investors make money in the stock market through capital gains, dividends, and the power of compounding. Although no investment is guaranteed, patience, discipline, diversification, and a long-term perspective have historically been key factors in building wealth through the stock market. The stock market is always changing. Sometimes prices rise for months or even years, while other times they fall sharply. Investors use two simple terms to describe these market conditions: the bull market and the bear market. Understanding the difference between them can help you make better investment decisions. A bull market is a period when stock prices are rising and investor confidence is high. During a bull market, businesses often report strong profits, unemployment is low, consumer spending increases, and the economy continues to grow. As investors become more optimistic about the future, more people buy stocks, pushing prices even higher. This positive cycle can last for several months or even years. In contrast, a bear market is a period when stock prices fall significantly, usually by 20% or more from recent highs. During a bear market, economic growth slows, company profits may decline, unemployment can rise, and investors become more cautious. Fear replaces optimism, causing many investors to sell their stocks, which pushes prices even lower. Several factors can trigger a bear market, including high inflation, rising interest rates, economic recessions, geopolitical conflicts, financial crises, or unexpected global events. These situations create uncertainty, making investors less willing to take risks. It's important to understand that bull and bear markets are a normal part of investing. Throughout history, every bear market has eventually been followed by a recovery, and every bull market has eventually experienced corrections. Financial markets naturally move through cycles as economic conditions change. Successful long-term investors don't try to predict every market movement. Instead, they focus on investing in quality companies, staying diversified, and remaining patient during both good and difficult times. Many experienced investors even see bear markets as opportunities to buy strong companies at lower prices. In simple terms, a bull market represents optimism, rising prices, and economic growth, while a bear market represents caution, falling prices, and slower economic activity. Understanding these market cycles helps investors remain calm, avoid emotional decisions, and focus on long-term financial goals. A stock market crash is one of the most dramatic events in the financial world. In a crash, stock prices fall rapidly over a short period, causing billions or even trillions of dollars in market value to disappear. While crashes can create fear and uncertainty, they are a natural part of financial markets and have occurred many times throughout history. One of the biggest causes of a stock market crash is panic selling. When investors become worried about the economy or a company's future, many begin selling their stocks at the same time. As more people sell, prices fall quickly, which causes even more investors to panic and sell. This chain reaction can turn a normal market decline into a full-scale crash. Economic recessions are another major cause. During a recession, businesses earn lower profits, unemployment rises, and consumer spending slows down. As companies struggle to grow, investors become less confident, leading to falling stock prices across the market. High inflation and rising interest rates can also trigger market crashes. When inflation becomes too high, central banks like the Federal Reserve often increase interest rates. Higher borrowing costs make it more expensive for businesses to expand and for consumers to spend money. As economic growth slows, investors may begin selling stocks, pushing prices lower. Unexpected global events can also shake financial markets. Wars, pandemics, political instability, natural disasters, or major banking crises create uncertainty about the future. Since financial markets dislike uncertainty, investors often react by moving their money into safer assets, causing stock prices to decline sharply. History provides several famous examples of market crashes. The 1929 Wall Street crash contributed to the Great Depression. The 2008 global financial crisis was caused by problems in the housing and banking sectors. More recently, the 2020 COVID-19 pandemic triggered one of the fastest stock market crashes in history, as investors feared the global economy would come to a halt. Although stock market crashes can be frightening, history also shows that markets have recovered after every major downturn. Many of the world's strongest companies continued to grow after these crises, rewarding patient long-term investors who stayed invested instead of selling in fear. In simple terms, stock market crashes are caused by a combination of fear, economic weakness, inflation, rising interest rates, and unexpected global events. While crashes cannot always be predicted, understanding why they happen helps investors remain calm, avoid emotional decisions, and focus on long-term financial success.